Shawn, thanks for taking a few minutes to talk with me about SPACs. First of all, why don't you just tell us what is a SPAC?
Sure. So a SPAC is an acronym for a Special Purpose Acquisition Corporation. It's nothing more than a publicly listed pool of capital that sits in trust and is managed by a founder or a sponsor with the specific objective of finding a company to merge into and effectively take public.
So why does everyone care so much about SPACs right now?
Sure. So they're obviously all over the press. The way to think about it is, post-COVID lockdown, there was a tremendous amount of disruption that happened in the capital markets. And what came out of that with the snapback and recovery was an explosion in the issuance of these special purpose acquisition companies. 250 were raised since the summer of 2020, representing about 75 billion of capital. That's more capital raised in SPACs than all of last year in the primary IPO market. What's more, since 2021, the run rate pace that was happening, frenetic pace that was happening in capital raising of SPACs in 2020, we hit half of all of last year through the end of February of this year. And the deal pace has exploded as well. So it's the place where most capital formation is happening today, and it's really disrupted large portions of the capital markets.
So how does SPACs work? I mean, who are the parties that are involved and why are they involved?
Sure, there's really numerous parties involved, but let's keep it simple. So there's a SPAC founder or sponsor, there's investors in the SPAC, and then there's a target company that has a set of shareholders associated with it as well. And the way a SPAC effectively works is the SPAC has effectively a 2-year clock to find a company to acquire. And after the SPAC is raised, it has public investors, it has a founder, and it has a 2-year clock to go out and find a company to buy that has its own, obviously, shareholders. If it finds a target company to buy, it reverse merge IPOs that company. Reverse because the SPAC is a smaller pool of capital than typically what is in the existing company. And IPO because it ends up being publicly listed as whatever the target company's core business was after the SPAC transaction closes. Typically called the de-SPAC is what you call it on the back end. So think of it from a SPAC investor's perspective like a convertible bond that's risk-free. They put their money into a trust. They have 2 years to decide whether or not to vote for a deal. If the founder finds a deal that they like, if they vote in favor of the deal, they can choose to redeem or not redeem, and they'll own shares in whatever that publicly listed company is afterwards, or they get their cash back. The important thing to think about here, and what's one of the big drivers, is what happens to the SPAC founders. If a $100 million SPAC is raised and it finds a transaction to do, the founders of that SPAC typically get 20 to 25% equity grant for doing a transaction. So from a founder or sponsor's perspective, Greg, a SPAC works like turbocharged private equity. They have 2 years to find a deal. If they find a deal, they effectively get a carry-like promote for having found a deal. They don't have to create value in the company like a private equity company would have to do. They don't have to hopefully enter at a lower multiple and exit at a higher multiple. All they got to do is find a deal to do and have it be voted on. And if it is voted on and approved, then they end up owning 20% of the equity. So it's really turbocharged private equity and how it works for a founder.
That's super interesting. So tell me a little bit, why is this a relevant mechanism for companies going public and sort of viewed in current market climate as a superior option to a traditional initial public offering or IPO?
Yeah, I don't think it's always a superior option. It's situationally. SPACs have been around for 25 years, but SPACs aren't new. What's new is this particular set of conditions in the capital market that have given SPACs a significant advantage over other forms of capital raising. When you compare a SPAC to a traditional IPO, in the current market, the discount from dilution that happens, an IPO typically has significant discount associated with the IPO offering. It's not inconsistent with what happens in a SPAC these days. And the big advantage a SPAC has in many ways over a traditional IPO is, if you go public through a SPAC, there is no S1 registration statement. You can have projections. You actually sit down and talk with investors on the front end of a SPAC when you're crafting the deal. So you're determining what the deal construct and valuation are going to be on the front end of a SPAC. And you're able to communicate directly with the shareholders using projections to craft what you view is going to be the trajectory of the company and reach a valuation point that you can both agree on for the deal to get approved. That's very unlike the traditional IPO path where you involve research analysts. You certainly can't have any sort of forward projections. Remember, in a SPAC also, or in an IPO, the pricing is the very last thing that happens. So the amount of price uncertainty that goes along with an IPO is very different because of the way the SPAC timing works. You actually price it at the beginning and then the vote happens at the back end. So there's a lot of advantages that a SPAC right now has over a traditional IPO.
So one more question. Is this going to end badly? It sort of looks a little frothy out there from someone who's been following capital markets for a long time. Is it a bubble?
Yeah. Is it going to end badly? I guess that question is always for whom is what you have to ask, right? Because on every trade, there's a buyer and a seller. It certainly looks overheated. There was some recent research that came out from Ritter, University of Florida, that shows how SPACs have done incredibly well for SPAC investors and certainly SPAC founders. They've done less well historically, putting it mildly, for investors in the companies that get de-SPACed. There's lots of arguments today about how the 2020 and 2021 vintage of SPACs is different than those historical trends in terms of underperforming once it's been de-SPACed. Look, there's value transfer and it's a mechanism to get public. The investors today are looking for ways to get access to what traditionally have been only available to many venture capitalists. So, is it going to end badly? I guess everything ends badly eventually. I think there's three things really that are supporting the SPACs today, that any one of the three, I think, could be a leg in the stool that would knock this over. The first is it's a blank check company up front, right? So they're putting forward projections and talking directly with investors. Many of the attractive aspects of getting public through a SPAC are about circumnavigating all of the regulatory complexities involved with the regular way IPO. So if there's some sort of fraud that happens in one of these transactions, that's going to put a significant dent in the forward momentum of SPACs. The second one I would say is, a lot of this is Fed driven. So, a SPAC requires at a minimum 3 times the amount of equity value, typically more like 5 to feel comfortable, relative to the SPAC capital infusion to offset the dilution that comes along with the SPAC. So if there's a compression in valuation multiples, I think everybody that looks in the market today would say, whoo, valuations are pretty high. Those higher valuations make it easier for a SPAC to be competitive with an IPO and easier to vote in favor of a SPAC transaction vote than it would otherwise be. So if for no other reason the valuations in the market come down, that will put a brake on this as well. And then the third I would say is that, all of these companies that have now announced de-SPACing transactions, a lot of electric battery automotive companies, I think there was more than 50 billion of de-SPACing transactions in the month of February alone. all of which have a set of lofty projections dependent on lofty valuations? Answer is we'll see. The next 6-9 months as these de-SPAC companies start to report quarterly earnings, do they deliver on the projections that they've laid out, or do they not? And if they don't deliver, those stocks are going to take a significant hit, and the market will penalize those SPACs that have overpromised and underdelivered. So like any natural capital markets phenomenon, at some point it's self-correcting. It's just a question of how fast and how hard.
That's great, Shawn. Thanks so much for taking the time to chat about SPAC, something that lots of people have been wondering about, and sort of a new and fascinating part of capital markets. So from there, we'll just wrap it up.
Terrific. Thanks a lot, Greg. It's always a pleasure.